The U.S. stock market is currently closed before the opening bell on this Monday, June 29, 2026, so we are tracking the latest official closing price for Nuburu Inc., ticker symbol BURU, which finished the previous trading session on Friday, June 26, at exactly $0.14, representing a notable downswing of over 21% on intense trading volume. If you just look at that single data point on your typical trading platform or smartphone screen, you might conclude that this penny stock is in a hopeless freefall toward zero. But the hidden reality beneath that dramatic price drop is something that almost no retail investor is talking about right now. While the broader market has been obsessing over massive tech plays like Tesla stock, Apple stock, and Nvidia stock, this tiny nano-cap company has quietly completely altered its corporate identity over the last 90 days by shifting into highly sensitive defense contracts and overseas industrial operations. The immediate reaction for anyone engaging in self-investing or managing an individual brokerage account would be to run away from a 14-cent asset that has lost the vast majority of its value over the past year. However, if you look at the actual filings and transaction logs from the last few weeks, institutional positioning and extreme spikes in volume show that short-term sellers are locking horns with aggressive accumulation buyers. This tension between what the public thinks is happening and what is actually showing up on the corporate balance sheet creates an incredibly compelling layout for anybody looking to invest online. Most retail market participants check out major popular sites or load up their basic mobile tools, assuming that a microcap laser company is nothing more than a speculative lottery ticket. But the reality of their recent defense pivot, combined with a major European corporate consolidation, completely challenges that standard narrative. Let us establish some common ground first, because it is vital to understand why the general sentiment around this company is so incredibly beat up. If you look at the long-term price chart on standard online investing apps or follow tracking tools, you will see a business that underwent a major reverse split earlier this year just to maintain its presence on the NYSE American exchange. For anyone relying on automated platforms or standard algorithmic systems like Schwab Intelligent Portfolios, this stock often gets flagged as a high-risk entity due to its historical net losses and capital deficits. The common view among conservative market observers is that microcap technology companies are constantly burning through cash, diluting their shareholders, and struggling to find commercial validation. This expectation of ongoing pain is exactly what drove the stock down to its current absolute lows, hitting a point where its market capitalization is sitting right around $26 million. But now, let us contrast that bleak expectation with the structural reality of what has occurred throughout May and June of this year. Just a few weeks ago, the company announced its official financial results for the first 3 months of the year, and the numbers revealed a massive structural shift. They went from zero revenue in the prior year's opening quarter to tracking hundreds of thousands of dollars in new inflows, driven primarily by their newly consolidated subsidiaries. Even more critical for their regulatory survival, they managed to reverse a massive multi-million-dollar stockholders deficit, completely shifting back into a positive equity position of over $2 million. For individual brokerage accounts tracking balance sheet health, this eliminates an immediate threat of forced delisting due to equity shortfalls. They achieved this by restructuring heavy preferred obligations into future common stock issuances, clearing the near-term hurdle that was choking their financial flexibility. When you look at recent trading volumes, something highly unusual is happening with this asset. On a typical day, a company of this microscopic size might trade a few 100,000 shares, but recently we've seen daily trading volumes explode into tens of millions of shares during highly volatile sessions. This level of liquidity indicates that large blocks of shares are changing hands, often a sign that smaller retail traders are capitulating and dumping their holdings, while specialized entities or institutional funds are quietly building positions. For those utilizing sophisticated execution tools on an interactive brokers platform, analyzing this volume expansion alongside institutional filings reveals that the traditional retail panic is serving as the liquidity engine for deeper pockets to enter the fray. This massive divergence in trading behavior is where the true narrative of the asset begins to separate itself from simple forum chatter. Let us dig directly into the massive catalyst that has been unfolding throughout this month. In mid-June, the company finalized a major strategic filing with the Italian government regarding their majority acquisition of a defense and mobility technology provider called Tecne. This is not just a standard corporate purchase, it is a structural play to position themselves directly within a massive European security infrastructure. They have already outlined a multi-year defense strategy tied to this acquisition, aiming for hundreds of millions of dollars in potential defense program scale running through the end of the decade. Because this involves foreign national defense, the transaction requires a formal regulatory review process by the Italian government, which the company officially triggered this month. If this review clears, they instantly transform from a struggling industrial component manufacturer into a key provider of defense mobility and directed energy counter-drone hardware on an international scale. Comment below how many shares of Nuburu stock you currently hold, or if you are avoiding microcap tech entirely right now.
Gathering perspective from the community helps us see if individual investors are actively tracking these obscure defense pivots, or if everyone is strictly focused on blue-chip names. Beyond the European defense sector, the domestic manufacturing pipeline is also showing signs of life that the current 14-cent stock price completely ignores. The company recently disclosed a multi-million-dollar blue laser customer quotation that is currently under active evaluation for automated industrial applications. When a company has a total market value of under $30 million, securing even one or two contracts valued at $2 to $3 million completely alters their near-term revenue trajectory. This is the core reason why the stock experienced an aggressive 8% breakout above its key technical resistance levels late last month, testing lanes that had capped its performance for weeks. Although short-term profit-taking and macro pressures drag the price back down to its current level, the structural underlying demand for their high-power blue laser systems remains a key operational reality heading into the second half of this year. To truly understand why this technology matters, we have to look briefly at what the company actually builds. They specialize in high-power industrial blue lasers, which operate at a wavelength that is absorbed significantly better by highly reflective metals like copper, gold, and aluminum compared to standard infrared lasers. This technical difference means that their systems can weld and process critical components for electric vehicle batteries, aerospace hardware, and mobile consumer electronics with far greater speed and much less energy than traditional manufacturing tools. If you talk to anyone who analyzes production lines for companies like Tesla stock or Apple stock, they will tell you that manufacturing efficiency in battery packs and circuit connections is everything. This core technology has always held immense promise, but the company's past failure was its inability to turn scientific superiority into consistent commercial sales, resulting in the massive multi-year destruction of shareholder capital that brought the price down to pennies. The modern business model, however, is no longer relying solely on selling standalone laser boxes to commercial factories. By integrating their industrial laser intellectual property with mobile defense platforms and additive manufacturing systems through specialized joint ventures, they are entering a completely separate market vertical. Their recent collaborative work with domestic defense manufacturing groups involves building portable directed energy laser systems designed to neutralize unmanned aerial vehicles, which is an exceptionally fast-growing global market. When you look at the massive budgets being allocated by governments worldwide to combat drone threats, the reality of this business model shifting toward national defense contracts provides an entirely different layer of risk mitigation that standard commercial technology companies simply do not possess. As you look toward the future outlook for the remainder of this year and beyond, the investment thesis for this stock becomes an intense balancing act between severe execution risks and asymmetric upside potential. The primary risk is that the company remains highly dependent on successful regulatory approvals and the timely conversion of their massive contract pipeline into actual cash collections. If the Italian government creates unexpected hurdles for their acquisition, or if their defense joint ventures take longer than anticipated to generate meaningful billings, the company could easily find itself facing renewed liquidity pressures. This is why standard conservative advisors or large-scale asset managers using tools like Fidelity Investments or Schwab Intelligent Portfolios rarely allocate capital to entities at this stage. The possibility of further capital restructuring or dilution is an ever-present reality that any self-investing individual must constantly account for. On the flip side, the potential opportunities are massive if they execute even a fraction of their current roadmap. They are entering the upcoming quarterly reporting cycle with a significantly cleaner capital structure, positive stockholders' equity, and an active operational presence in multiple international defense initiatives. If they successfully close the European corporate acquisition and begin recognizing initial revenue from their counter-drone platforms, the market will be forced to rapidly reprice the asset away from its historical bankruptcy risk valuation. The absolute low price of 14 cents means that even a minor influx of positive corporate news or a small institutional capital allocation can trigger massive percentage gains, as we saw during their brief technical breakouts earlier this spring. When you look at how you should approach an asset like this within an individual brokerage account or on a modern digital trading system, it all comes down to position sizing and understanding the stark contrast between market perception and corporate execution. If you treat an investment here like you would treat a stable position in a major index or a mega-cap tech giant, you are setting yourself up for immense emotional volatility. Instead, sophisticated participants often view these microcap opportunities as asymmetric options contracts, where the downside is strictly capped at the capital deployed, but the upside can be multiple times that amount if the structural turnaround catches the broader market by surprise. Tracking this asset requires looking directly at regulatory filings, volume accumulation patterns, and contract awards, rather than simply watching the daily ticker fluctuations on a standard mobile dashboard. In summary, the central insights surrounding this business reveal a profound disconnect between past reputational damage and current operational transformation. The public expectation is that this is a failed penny stock bound for ultimate delisting, driven by years of cash burn and structural splits. The underlying reality, however, shows a business that has successfully cleared its immediate capital deficit, entered high-value international defense markets, and is actively awaiting major regulatory decisions that could unlock substantial long-term revenue streams. Whether you execute your trades through premium institutional avenues or casual modern apps, keeping an objective eye on this tension between narrative and numbers is exactly how you discover deep value before the rest of the street catches on. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Don't forget to like, comment, and share this video to support the channel.